Hey, it's Soleil, and this is episode 95 of the Orange Pill Investor. And today I want to talk about the strategy that I keep frickin' yammering on about, which is I sell covered calls to generate a premium, and then I take those profits and I buy more shares, and then when I accumulate more shares, I sell more covered calls. And I want to play this video. So let's just get one thing straight. This guy is way friggin' smarter than I am. So I'm like, I'm kind of annoyed that I am on the other side of what he's about to say. And then I'm gonna give my best defense, but also just kind of admit that I'm extremely wary about this now, even though the selling covered calls has done extremely well for me. Let me set this up a little bit. He did admit that selling covered calls has done well since the 80s, and I don't know if it has anything to do with us going off the gold standard shortly before that. He said that there were some correlations that that stopped after that, but he wanted to basically answer the question of what would you have to invest in for 100 years if you wanted your kids to still be set up well 100 years from now. And his basket of portfolio looks way different than anything I've ever seen. So I'm going to give my best defense, but the guy's probably right. But anyway, here's what he has to say about his study on a bunch of different stuff, but this is about covered calls. Listen in. All right, I think that's good right there. So basically, he just shit all over my strategy that I have been shouting from the rooftops and calling, buy and hold investors uh, and diversified people just basically lazy passive investors. And here's my best defense. So obviously, I was not trading during the Great Depression. However, I started trading right here in May, mid-May. And I actually, as that was crashing, I didn't know how far it was going to crash. And at some point, I just took my money. I told my guy that was in charge of my IRA at the time, or 401k, can't remember what I had, to take me to cash. And he's like, oh, when this recovers, it's, you're going to want to be, you know, participate in the recovery. And this was right about the time that a buddy of mine put me on to options. He was a completely different options trader, but I just started watching tons and tons of Tasty Trade videos, and I really liked selling options. So I would run the wheel. I would sell the puts. Then if I got assigned, I would own the shares, sell covered calls against it. If I got assigned, sell puts. And I would sell just about anything. I would go to Market Chameleon. Anything that had the highest implied volatility, I would go and check. If the premium was really good, then I would just trade that. And I would trade it until the premium wasn't very good anymore. And so I think maybe that's why it was successful, because he was criticizing mechanically trading these things. So, well, he didn't say mechanically. I use that word. I guess just trading by rule. It's like, okay, we're going to just trade this strike every time. And he didn't really explain whether they were trading at the money calls or going above the strike at, some amount, or how were they doing weeklies, were they doing monthlies, were they doing 90-day. So maybe it was in his paper. He's talking about his research that he did. And I'm probably going to have to do a deep dive on that. But the SPY, when I got in, was like at 300, 295-ish. And a year and a half later, at the end of 2021, when this was kind of coming to a close here around November, 18 months later, went from 300 to just over 450, which is approximately a 50% increase. Half of 300 is 150, it's up to 450. So everybody who just held here got 50%, returns. And really, they started at 300 here, and if they just held through this, I guess I call this the V-shaped recovery. Now, this wasn't quite a 70% like he described, so I don't know if I would have done well in that environment. But I beat the hell out of these guys, because it went from 300 to 450, so 50% increase, and I tripled my account. I started with like 30 grand. Actually, I'm going to start with like 5 grand. And I'm like, holy crap, I'm like collecting all this premium and just making money, because I was allowing for 10-15% call away value. So I'm collecting some of this, and I'm collecting premium, and I'm buying more, with the profits. So I'm like, holy crap, I put like 30 grand in and kept doing well. And I basically cashed out my IRA completely and started trading with about 70, and I turned it into 210 and 240 or something. So I basically tripled it. So it went up 200%. And 200% is a hell of a lot better than 50%. So I don't know if this COVID crash, what did we lose? We went from 330 to 220. So we only had a 30% crash, right? Third of that is about 110. Boom. So it's not apples to apples comparison. However, exactly what they did in the 30s that caused that sharp rally was lowering interest rates, basically quantitative easing, I guess, and which is exactly what they did here. So I was trading in a similar environment. It just may not have been as much of an extreme. And I beat the ever living shit out of the market, out of just the buy and hold. And so I don't know if it's because I was actively trading it and making good decisions, and if it was too robotic, like if you just programmed the computer to just trade for you based on a formula, maybe it wouldn't react well, or what. But I kind of wonder if it doesn't have to do with the the way that I do it, and I do it weekly. And really my strategy depends more on just math than deciding what to trade and what strikes to pick. Because if I get 1.01, a week, if I collect that much premium, I'm already getting a 52% return. So I'm kind of confused about how he's saying that strategy gets annihilated when a 50% return for the year. Granted, it's not the 70%. He said it rallied like 70% in a month. So yeah, I mean, I guess 50% in a year is not as good as 70% in a month, but it's still not annihilated. Like you're not suffering, and plus you saved money on the way down. And I'm taking profits and buying. So right here, I lost money on my portfolio value, but I'm still getting 1%, and I'm buying the dip here and getting however many shares I can get. And then down here, I'm buying this dip as well. So some of my shares are going to be unlimited profit. And maybe that's the difference, because if I'm buying the dip here and I got an extra 25 shares, I sell a covered call, and maybe that call goes against me. I get 10% call away value, and it goes up 30%, and then, maybe I sell the 25 shares that I got down here at 220, and I get to sell them at 286. So I make, 10% of 220 be, I make like 40% profit. No, it's not 40%. Whatever the hell it is. Anyway, I bought them for $228 and sold them for $282. So I made about $40 a share here. So 20%. Plus whatever, call away value. And then, I can just, sometimes you get lucky. And when I say, lucky, like here, okay, I sell a covered call here, and then catch this dip, and then maybe I buy a couple more shares at 300, and then it comes up again. So I don't know if COVID is a good enough example to say that I beat the strategy that he's saying got annihilated. But especially once your account gets big enough, when this is happening, I'm not just buying one or two shares. I'm buying hundreds of shares. I call it reaching critical mass, because when if you have like 10,000 shares of something and you get 1% profit, 1% of 10,000 is 100. So you're going to have enough cash to buy 100 more shares, which means you get to sell an additional covered call. So the price of the value of your portfolio is less, but the number of shares has increased by 100 shares. And then you can sell another covered call, and then you can buy one more share. So you're getting 1% on top of 1%, and doing that every week, you're compounding that profit, which is 1.01 to the 52nd power. So you're going to get 70% for the year. It's still, that doesn't, but that's just in premium too. I'm allowing 10% call away value every week. I mean, if it went up 20% a week, and I'm only capturing 10, that's still 10% a week for 52 weeks is still, what is that, 50x. So I just don't get it. I mean, unless it's just straight up face melting, I just don't make as much money as some of the other strategies. And then, so I don't make as much during this part. But then it's not long, another 18 months. And then guess what? Everybody who's buying and holding and was like patting themselves on the back for being geniuses and got this 50% return from their losses, they're like, oh, glad I held. I was at 320. I could have panic sold. I didn't. Now I made 50% returns. You're patting yourself on the back, and as soon as you start patting yourself on your back, you get screwed. And so now you're going to ride your $300 or 50% returns. You can ride that all the way back down to barely even a profit anymore. Now it's down to your profits up from 300 to 360, so 10%, 20%. So you made 20% now. And then you got to wait for it to go back up again. And now we're at all-time highs again at 500. So now you've not quite doubled your money from when it was 300. So I don't know. I mean, the guy still has me nervous because I've listened to the video twice now, and I'm just nodding like, holy crap, I'm getting it. I'm like totally into what he's saying. And then he just dropped that bomb on me halfway through the video and just shit all over my strategy. And so shook my faith a little bit, but I can always figure out a way to justify something, when I have a strong bias. So I should have been a lawyer. But yeah, I mean, I was able to trade this and actually absolutely slaughter the market with them just dropping interest rates, fast and hard. And this was a pretty violent upswing. So I don't know. I got to keep an eye on it. And maybe the thing is when you get a massive drop like this, maybe you just get really conservative with your calls. Instead of 10% call away value a week, maybe I go to like 20%. I'm collecting tiny little bits of premium, but maybe just and buying little shares with it, but just mostly waiting on the recoveries. And then once we've gotten back to here, maybe it's business as usual, and I just sell covered calls the rest of the way. But then again, maybe it's just because I don't know. I mean, these guys are trying to deliver value to their accounts, and what I'm doing, like during this whole time, I mean, I had my regular job, so I can just live off of my paycheck. But if I had to live off my paycheck and make enough money to like keep buying shares, maybe it wouldn't have worked as well. But if you have 20,000 shares of something, and I'm thinking, by the time you retire, if you got 20,000 shares of something, you can buy two, getting 1% a week. You're getting the premium, plus you're buying an extra 200 shares, which means you can sell 2 extra covered calls. But maybe you can live off half of that. Maybe you can live off the 100 shares, and you have 20,000, you have enough money to buy 200, but you only buy 100, and you live off the other 100 shares, whatever the value of that is. Maybe that works. So I'm annoyed, but that was my best defense I could come up with, and I'm definitely going to read his article and do some research and see if I can figure out a solution. I really enjoy what I do, so I'm definitely biased. I'm definitely looking for a way out and a reason to keep doing it. And all right, I think I will leave it there. Be good, Joe.